Welcome to This Explainer. Today we're cracking open a process that is absolutely fundamental to the real estate world, but it's also heavily clouded by some pretty dangerous and expensive misconceptions. We're talking about the mechanics of commercial real estate refinancing. Look, if you own, manage, or invest in property, this is that make-or-break moment in the investment lifecycle. It can either secure your asset's future or, frankly, entirely derail it.
So the myth is simple, right? You probably think, hey, my loan is maturing, I'll just roll it over, sign a few papers, tweak the term, and we're good to go. But here is the reality. A refinance is a full re-underwriting. You are starting from zero. Imagine walking into your office tomorrow morning and having to rigorously apply, interview, and test for the exact job you already hold, just to keep your desk. No way, right? Well, that is exactly what your property is about to go through with a lender.
Okay, let's dive into this. Here's our roadmap. We've got 5 stops. First, the big refinance myth. Second, the 3 crucial tests. Then, running the numbers, types, and lenders. And finally, hidden costs and timelines. Let's get to it. Section 1. The big refinance myth. Starting from zero. The absolute core of this myth is that idea of a simple renewal. We need to make this crystal clear right out of the gate. A commercial refinance is not a renewal of your old loan.
Here's the hard truth. Your existing loan terms, they don't matter. What actually matters is what the asset can support today. The lender pricing your new facility doesn't really care how easily you made your payments over the last 5 years. They are literally wiping the slate clean. Your income is reassessed entirely against current occupancy and leases. Valuations are reassessed against today's cap rates. It's a completely fresh underwriting exercise, regardless of how stellar your past performance was.
Section 2. The 3 crucial tests, the refinance gauntlet. These are the 3 strict, unforgiving metrics that are going to absolutely dictate if your new loan survives underwriting and exactly how much capital you can actually walk away with.
First up in the gauntlet is loan to value, or LTV. Now, you might remember your LTV from back when you bought the property, but lenders at Refinance are looking at 65% to 75% of the current appraised market value, not your original purchase price. And here is the trap. If cap rates in the broader market have widened, meaning investors want higher returns, which pushes property values down, your reappraised value gets crushed. Even if your net operating income hasn't dropped a single penny, a wider cap rate shrinks your property's value, and that directly compresses the maximum loan amount a lender will offer you.
Next is the debt service coverage ratio, DSCR. This just dictates that your net operating income has to cover your annual debt service, your loan payments, by 1.25 to 1.35 times. But here is the kicker, and it's a big one. This is tested against the new loan's interest rate. If you're refinancing from, say, a 3% rate into a 6% rate, this test is where it bites the absolute hardest. The exact same income that comfortably paid your old mortgage might suddenly fail this coverage threshold. And when that happens, the lender forces you to take a smaller loan, meaning you have to bring a massive check, additional equity, to the closing table just to make the math work.
And the final test, debt yield. This is your current net operating income divided by the proposed loan amount. Institutional lenders absolutely love this metric. Why? Because it acts as a hard floor that's completely independent of property valuation. It brilliantly strips away all those optimistic cap rate assumptions a borrower or an appraiser might try to use to inflate the property's worth. It just looks at the raw, undeniable cash flow relative to the loan size.
So the crucial point here is that 8.5% to 10.5% range. You've got to understand that this typical debt yield floor is not some flexible target. It is a hard floor. If your NOI divided by your loan request doesn't hit this range, the lenders simply won't give you that loan amount. They'll resize the loan downward until the math hits this floor.
Section 3. Running the numbers, the stress test. Let's take these abstract concepts and actually put them through a real-world stress test. We're going to see how the weakest link among these 3 tests will ultimately limit your loan proceeds.
Okay, here is our setup for a theoretical property. We've got a current property value of £10 million. It's generating £750,000 in net operating income. And you have an existing loan of £6.5 million that is maturing and needs to be replaced. You're hoping to pull out a $7 million loan to cover the old debt and maybe some closing costs too. So let's see what happens. And this brilliantly illustrates how the gauntlet works in a stable market. Let's see how that $7 million loan fares. First up, LTV. A $7 million loan on a $10 million value is 70%, which passes the typical 70% maximum. Awesome. Second, DSCR.
With an estimated $550,000 in new debt service, $750K divided by $550K gives us 1.36x, so it just squeaks past that 1.35x threshold. Passes. Third, debt yield. $750K divided by $7 million is 10.7%. That comfortably clears the 10.5% floor. So in this perfect scenario, all three tests pass and you get your $7 million.
But wait, let's put ourselves in the sponsor's shoes when the market shifts. What happens if the weakest link breaks? Let's say your property is performing exactly the same, generating the exact same income, but market cap rates soften. Investors want higher returns, so suddenly your property value drops from $10 million to $8.5 million. Your income is fine, so debt yield and DSCR might still look okay. But look at LTV. A 70% LTV limit on an $8.5 million value caps your new loan at $5.95 million. Remember, your existing maturing loan is $6.5 million. Because of one valuation variable entirely outside your control, you are suddenly short over £500,000. Ouch. The constraint that binds shifts with market conditions for sure, not just with your asset's performance.
Section 4. Types and lenders, strategy and selection. Let's pivot away from the brutal math for a second and talk about strategic decision-making. What is your actual objective with this new loan? And who should you ask to fund it?
There are three main refinance objectives to consider here. First, rate and term. This is simply replacing the existing loan to reprice your debt or extend maturity without really changing the loan amount much. Second, the cash-out refinance, where you pull built-up equity out of the property as liquidity. But beware, cash-out proceeds are the absolute first casualty when coverage tightens. If valuations drop like we just saw, that option vanishes instantly. Third is bridge to permanent. That's used to replace short-term transitional debt with long-term financing once a property has stabilized its income.
Now, here is a golden rule. The lender who originated the loan is not automatically the right lender to refinance it. Different institutions price senior debt entirely differently depending on the market cycle. An asset that perfectly suited a bank 5 years ago might be a way better fit for an insurance fund today. Also, do not assume your old terms carry over. Personal guarantee terms like recourse burn-off triggers that you fought so hard to negotiate during origination, those do not automatically transfer to the new lender. You're starting those negotiations completely from scratch.
Section 5. Hidden costs and timelines, the final traps. So, we've survived the mathematical gauntlet, but we aren't safe yet. Let's look at the logistical and financial pitfalls that can quietly but drastically erode the benefits of your new loan. There are three major hidden traps you absolutely must account for. First, prepayment penalties. If you're paying off your old loan early, provisions like yield maintenance or defeasance can absolutely wipe out the savings of a lower interest rate. You've got to quantify these before you pursue a refinance. Second, transaction costs. We're talking independent appraisals, legal due diligence, title work, origination fees. On institutional scale facilities, these easily run into the tens of thousands of pounds. Third, the timing cost. If this process takes longer than expected, you're left carrying the dual assumptions of your maturing loan and your new loan, just floating in a dangerous spate of uncertainty.
Let's move to the timelines and see how this builds in reality. Bank lenders are typically the fastest, usually wrapping up in 6 to 10 weeks if relationships and property types are straightforward. Insurance companies and debt funds, they dig a bit deeper into the re-underwriting, commonly requiring 8 to 14 weeks. And CMBS conduits, they are the slowest and least flexible, easily taking 16 weeks or more, mainly because their execution is entirely dependent on rigid securitization and loan pooling schedules, not just an internal credit committee.
This timeline reality brings us to a completely non-negotiable rule. Early engagement matters. You need to assemble your current rent rolls, your trailing 12-month operating statements, and your exact payoff amounts before you even have that first lender conversation. Think about it. When a standard lender process takes 3 to 4 months, that leaves literally zero room for correction if you start close to your loan maturity date. Intense preparation is your only defense.
So what does this all mean? A commercial real estate refinance is a complete and total reset. The LTV, DSCR, and debt yield are going to vigorously test your asset against today's harsh market realities, not yesterday's successes. So I'll leave you with this final critical thought to assess your own portfolio. Is your asset truly ready to survive the re-underwriting gauntlet? Thanks so much for joining me for this explainer. See you next time.